country's first fully locally owned commercial bank came on June 19, 1965, when the Cooperative Bank of Kenya was registered as a cooperative society, initially to serve the growing farming community. Co-op Bank, as it came to be known, commenced operations as a bank on January 10, 1968, with a start-up capital of only 255,000 Kenya shillings, supplemented by an interest-free loan from the government of 214,000 Kenya shillings, repayable in 10 years. The first fully government-owned bank, the National Bank of Kenya, was established on June 19, 1968, with John Michuki, then Treasury Permanent Secretary, as chairman of its board of directors. 2 years later, Michuki was appointed executive chairman of the newly established Kenya Commercial Bank. His place at the National Bank of Kenya was taken over by Stanley Githunguri. The government set up Kenya Commercial Bank after buying a 60% stake in the National and Grindlays Bank and splitting the bank up into two banks, the Kenya Commercial Bank and Grindlays Bank International, Kenya. KCB took over all but two of the branches previously operated by National and Grindlays Bank in Kenya. It was those two branches that constituted Grindlays Bank International, Kenya. Of the three newly established Kenyan banks, KCB quickly outpaced NBK and Co-op Bank, mainly on account of having more capital and a substantially broader branch network. In November 1976, the government assumed full ownership of KCB by buying out the 40% stake initially retained by Grindlays Bank of London. The formation of the government-owned banks had the desired effect of speeding up the provision of affordable banking services to the majority of the population. It also prompted foreign-owned banks to take measures to remain relevant in the Kenyan market and beyond. In 1969, Standard Bank of South Africa merged with the Chartered Bank of India, Australia and China to become the Standard Chartered Bank, StanChart. On its part, Barclays shed the Dominion Colonial and Overseas DCO tag to become Barclays Bank International. A decade later, it was locally incorporated in Kenya as Barclays Bank of Kenya, with Samuel Waruhiu as its first chairman, while T.D. Miles became the managing director. Barclays would later become the first bank in Kenya to offer its shares to the public, when in 1986, it floated 30% of its equity on the Nairobi Stock Exchange. The government and foreign-owned banks would not continue their virtual monopoly on banking for long. During the decade or so following the death of President Kenyatta in 1978 and his succession by his Vice President Daniel Arap Moi, 7 new banks and 33 non-bank financial institutions came up to join the single private indigenous bank, Co-op Bank. The main characteristic of these new banks and financial institutions was that they were small in terms of start-up capital. In 1980, the minimum capital required to establish a bank was 2 million shillings. That of non-banking financial institutions was 500,000 shillings. But as the new bank started experiencing cash flow and other problems, the central bank raised the requirements for start-up capital. By 1982, it was 5 million Kenya shillings, and by the end of the decade, it had been increased to 15 million Kenya shillings. But by then, a number of the new locally owned banks were finding it difficult to keep afloat. 12 banks collapsed between 1984 and 1989. This first wave of bank collapses forced the government to pass the Banking Act of 1989, which, among other things, tightened requirements for the licensing of new banks and non-banking financial institutions. The minimum capital requirement was substantially increased. Deposit insurance was made mandatory, and overlending and earning interest on non-performing loans were prohibited. and to protect depositors and oversee bank liquidation, the government set up a Deposit Protection Fund Board. In December 1989, the government combined the deposits and assets of 9 of the collapsed banks to form the Consolidated Bank of Kenya, and mandated the new bank to undertake the task of reimbursing the deposit customers of the collapsed banks. Despite the government's new regulations, there would be a second wave of bank failures between 1993 and 1995, affecting 19 banks. Several of these collapsed banks had been indicted in the infamous Goldenberg scandal of the early 1990s, associated with businessman Kamlesh Patni. But the story of local privately owned banks has not been the story of bank failure after bank failure. Indeed, indigenous banks have carved out a niche for themselves, not only by competing with the long-established banks for mainstream clients, but by diversifying their customer base to include Kenyans in the low-income class and informal or Juakali sectors. Equity Bank, established as the Equity Building Society in 1984, stands out as the indigenous bank that has greatly tapped into this market to attain phenomenal success. The bank is the market leader in terms of account holders and innovative products and services targeting Kenyans in the lower middle and low-income classes. The bank and its Chief Executive Officer, Dr. James Mwangi, have won numerous local and international awards in recognition of their performance.
It is true the 80s and early 90s was characterized by massive failure of what was regarded as the indigenous financial system or banks. The biggest failure came to a great extent by mismanagement. As we said, the competencies, the skills were not very resident in the majority of the people. The conflict between ownership and management, particularly in governance, was also a major cause. And the reason why we succeeded was very strong governance structures from the onset. We separated ownership and management, and that helped us a lot. I myself came as a manager. I was not in the ownership structure. And that separation allowed us to really manage what we could say conflict and a greed that was eminent, that when people saw money, they assumed it was their money and not the depositor's money, and diversified their investment using insider borrowing. So we were able to avoid that curse. I remember when I joined Equity, we were number 66 out of 66. And seeing today that we are the #1 bank in number of customers, profitability, market capitalization in the country, we have really grown.
Other examples of banks targeting lower income and special customers are Jamii Bora Bank and 2 fully fledged Islamic banks, First Community Bank and Gulf African Bank.
You know, the reason why we decided we wanted to be a bank, we were a microfinance institution and we had grown very big. Even though we started with 50 beggars and had not planned at all to grow big. We grow very big because the poor desperately need access to finance for their tiny, tiny businesses that nobody thinks of as a real business. And when the central bank was going to regulate microfinance institutions, I was the vice chair of AMFI, the Association of Microfinance Institutions, so I was very much involved in these negotiations. We started saying that what they're asking us to do and to be is almost like being a bank, so why don't we become a bank? And we had also seen our members grow from extreme poverty, and some of them grew very fast, and they were now coming into big business. Now they were above what we could do in microfinance, and they would have to go to the bank. But the bank they went to then didn't know their history, didn't understand that somebody who had never finished even primary school could be doing such big things. But we understood because we had seen them grow. So we decided we must be a bank ourselves.
As they have grown to meet the demands of an expanding market, Kenyan banks have had to cope with a changing foreign exchange situation that has continued to pose a great challenge to their operations. Following the international gold crisis of early 1968 and its resultant devaluation of the British sterling pound to which the Kenya shilling was pegged, the central bank and the Kenya government found it necessary to impose foreign exchange controls and import licensing. By 1976, the central bank issued a raft of measures aimed at conserving foreign exchange while improving the liquidity of commercial banks and other financial institutions. By the beginning of October 1982, partly due to the abortive coup attempt of August that year, Kenya was reeling under a major foreign exchange crisis. The country's foreign exchange reserves could only last between 2 to 6 weeks, as opposed to the conventionally accepted minimum of 3 months. This forced the central bank to introduce even more restrictions on imports, thereby limiting companies from bringing in raw materials and spare parts essential to their operations. The result was widespread losses in the private sector and inevitable employee redundancies.
And you can imagine, in those periods, all the countries in this region were exercising price control. The paradigm changed. Remember structural adjustment? Yeah. Structural adjustment policies by the World Bank were actually, and perhaps even the IMF, were actually saying, let the market determine prices, and then you are going to see investment flowing in sectors that are profitable. Okay? That's why you realize, if you want to look at the history, you can see that why did we become the fastest and maybe the first cut flour exporter, and there were many investments there. So that is the paradigm change from the 70s. The 70s was, if you control even credit allocation, you are going to define the priority sectors. But then the market cannot on its own create or generate the resources that are required. So it is the thinking that also changed. As you continued with the price control because of scarcity, then it became a distortion. But don't forget that it was a policy that was there at the very beginning. All these countries were fixing prices. The thinking then was that for a young nation, it is going to direct growth in priority sectors. But then over time, the market starts seeing that it is a constraint. As foreign exchange dipped, then controls tightened.
Throughout the 1980s, Kenya's foreign exchange situation remained precarious. It was under these difficult circumstances that Duncan Ndegwa exited the helm of the central bank in April 1983. He was succeeded by Philip Ndegwa, until then the chairman of KCB. Major problems for the financial sector of the economy would, however, continue, despite the change of guard at the central bank. The shilling continued to steadily depreciate against major world currencies. By December 1992, the shilling had gone from 7.143 to the dollar in 1972 to 36.216. In March 1993, the shilling was devalued by 25%, raising its exchange rate to the dollar to 45. 3 months later, the dollar exchange rate had skyrocketed to 65.